Welcome to the deep dive on Criteos Q3 2025 earnings.
Hey there.
We're here to, cut through that dense transcript and really pull out the essential financial and strategic bits.
Exactly. And what a quarter to dive into. The market reaction was pretty enthusiastic.
It really was. Suggests a strong, clean beat, maybe validation for that big strategic pivot they've been working on for years now.
Definitely feels like validation.
Yeah.
More than just good numbers, it felt like proof the transformation into a commerce media leader is actually working.
Absolutely. When management delivers like this and the cash flow backs it up, well, you need to pay attention. Let's start with the results snapshot because honestly, the profitability was genuinely impressive.
Yeah, the earnings beat was substantial. Non-GAAP diluted EPS hit $1.31.
Wow, okay. And consensus was where?
Way lower, somewhere between like 89 and 93 cents. So we're talking a beat of around 40 cents, maybe a bit more. That shows real operational outperformance.
Okay. And the top line? Revenue?
Revenue was $470 million. That's up about 2% year over year. Pretty much flat if you look at constant currency.
Right, but that revenue figure doesn't really tell the whole story here, does it? The key metric is contribution ex-TAC, the CXT.
Exactly. CXT is the number to watch. Think of it like their gross profit on ad spend after paying traffic costs. That came in at $288 million.
We're in a graph there.
Healthy. Up 8% year over year, or 6% in constant currency. That's solid growth on their core profitability base.
Okay, and here's where it gets really interesting, right? The leverage. Adjusted EBITDA.
Hit $105 million. That is a huge jump, 28% year over year.
Which translates to margin expansion.
Big time. The adjusted EBITDA margin reached 36% of that CXT. That's up 500 basis points from last year. 5 full percentage points.
Wow, 500 basis points. That's not just noise, that's structural improvement.
Exactly. It changes the whole profit profile. Every dollar of CXT is just much more profitable now. And the cash flow proves it out. Free cash flow was $67 million in Q3.
Up how much?
Up 74% year over year. It just confirms that disciplined cost management is working hand in hand with that solid CXT growth.
Okay, let's unpack that. Operational fitness, 500 basis points doesn't just happen. Where did that leverage come from?
Well, fundamentally, it came from holding the line on costs. Non-GAAP operating expenses were flat year over year, $158 million.
Just flat. So not cutting, but holding steady while CX2 grows.
Right. And it's not just about being frugal. They specifically called out productivity gains, driven by AI tools, automating campaign work, optimization that's driving real efficiency.
Makes sense. Okay, shifting gears to the segments. Retail media, the big growth engine. How did that look?
Still very strong. RM contribution ex-TAC grew 11% at constant currency. And maybe more importantly, activated media spend the money flowing through their platform grew 26% year over year.
So outpacing the market.
Seems like it. And they're scaling up. Now over 4,100 brands using the platform globally.
Okay, so RM is humming along. What about the other side? Performance media, that's been undergoing a bigger transformation, right?
Yeah, PM's really interesting. CXT there grew 5% constant currency. But the story is the shift away from that old high-touch managed service.
Towards the self-service platform, Commerce Go.
Exactly. Commerce Go. It's AI first, designed for efficiency and scale.
Now, historically, pushing clients from managed service to self-service can be tricky. You risk losing some revenue, maybe some clients. Did they talk about that?
They didn't dwell on the risk, more on the success metrics, which kind of answers the question implicitly. They're seeing lower costs to serve, which you'd expect, but also, importantly, higher overall spend and better return on ad spend for the clients using Commerce Go.
Higher spend. That's impressive.
It is, and the adoption curve looks great. They said 1 in 4 campaigns from their smaller clients are now running through Go. That's up from just 10% last quarter.
Wow, 10 to 25% in one quarter.
Yeah, and they expect that to double again by the end of the year. That's fast uptake.
And it's pulling in other channels too, right? Social media.
Right. Social now makes up about 35% of the campaign revenue flowing through Commerce Go. So it's becoming a more holistic tool, not just for traditional display.
And looking forward, are they expanding channel reach further?
They mentioned connected TV, CTV, calling it a big multi-year growth opportunity where they feel they're still underpenetrated. Make sense? Leverage the data they already have.
Okay, so operationally, a really strong picture. Leverage, AI efficiency, segment transformations clicking. But there's always a but, isn't there? Let's talk Q4 guidance. It caused a little bit of noise.
Yeah, the Q4 guidance was maybe the one slight point of caution. But let's frame it correctly. Even with that, they raised the full-year adjusted EBITDA margin outlook.
Oh, they did?
Yes. Raised it to approximately 34%, up from the prior range of 33-34%. So fundamentally, they're showing confidence in the underlying profitability, regardless of some temporary Q4 stuff.
Okay, that's important context. But the Q4 CXT guide itself, what was it?
$325 to $331 million, which, yeah, implies a year-over-year decline of about 3% to 5% at constant currency.
So, why the sudden softness after such a strong Q3?
They were very specific, pointed to two temporary things. First, scope reductions at just two specific large retail media clients.
Okay, isolated incidents.
That was the implication. And second, they're lapping some significant one-time tier fees from Q4 last year. So a tough comparison. They were clear this Q4 dynamic isn't the expected run rate for 2026.
Got it. Temporary headwinds. Okay, moving beyond the quarter-to-quarter noise, the big structural news was the redomiciliation plan.
Right. This is a multi-step process. First, redomicile the top company to Luxembourg, then eventually pursue a full U.S. domicile, maybe Q1 2027. And crucially, replace the current ADS structure with a direct Nasdaq listing targeting Q3 2026.
That sounds complicated. Why go through all that trouble? What's the strategic payoff?
It really boils down to flexibility and shareholder value. The main goal is getting out from under certain French legal complexities.
Like what?
Specifically, constraints on how much capital they can return to shareholders, especially through share buybacks. French law is apparently quite restrictive there.
So it's about unlocking the ability to do bigger buybacks.
That seems to be the primary driver, yes. Think of it like they have this growing cash pile and buyback authorization, but the current rules are holding them back. Moving allows them to actually use those tools effectively.
And the secondary goal?
Positioning for potential inclusion in major U.S. stock indices. And a direct Nasdaq listing in U.S. domicile makes that much more likely, which broadens the potential investor base. Long-term value unlock.
And they are already buying back stock, right? Even with the current limit?
Oh, yeah. They deployed $115 million on repurchases just this year so far, and they still have $104 million left on the current authorization.
So the redomiciliation is basically signaling we want to do more of this and faster.
That's exactly how it reads. It's a clear signal of intent to accelerate capital returns once the structure allows it.
Okay, beyond corporate structure, let's talk innovation. They mentioned agentic AI quite a bit.
They did. They see it as the next major shift in commerce. And importantly, they view it as an additional channel, something that creates new transactions, not something that just cannibalizes existing e-commerce.
How are they positioning themselves for that?
Three main areas. First, internal tools using AI agents to help build campaigns, audiences. Second, piloting sponsored recommendations within retailer AI chat agents.
Interesting. So native ads in AI chat?
Kind of, yeah. And third, proof of concept partnerships with major AI assistants, plugging Criteos product recommendation API into them to make the AI's shopping answers better, basically becoming the data plumbing for AI shopping.
That sounds ambitious. And speaking of partnerships, the Google deal sounds massive.
It really does. Criteo is now Google's first on-site retail media partner.
First, okay. And the numbers they threw around, something like $172 billion addressable market.
Yeah, $172 billion. That's the estimated size of the brand search budget pool they can now tap into. It fundamentally changes the scope.
How does the API integration actually let them grab that search budget?
So, historically, retail media was about budgets spent on the retailer site. This partnership lets Criteo capture budgets spent on Google search by brands promoting products and then route that demand, that intent, directly to the retailer's site using Criteo's plumbing.
So it connects Google search spend directly into the retail media ecosystem via Criteo.
Exactly. Converts brand search spend into retail media demand. The API is live now, and they see it as a huge multi-year growth driver starting really in 2026.
That is some serious leverage on their existing infrastructure. And quickly, on the supply side, still adding retailers.
Yep, execution continues there. They highlighted the auction-based display format is growing fast now, 12% of the RM business, up from 9% last quarter. And they added some big names like DoorDash and Sephora.
Okay, so overall, it seems like really solid execution, margin expansion, and a big strategic simplification coming.
A masterclass, really, in turning the ship and delivering on the operational side while setting up for future flexibility.
Which brings us nicely to our This Is Not Financial Advice segment, the accelerated buyback arbitrage.
All right, let's put on the slightly more speculative hats here. Connect the dots.
The thesis is pretty straightforward, right? Go long CRTO, Why? Because there's a near certainty of accelerated capital return coming, but it's currently sort of masked by that short-term Q4 noise.
Exactly. The company is a cash machine, generated $67 million in free cash flow just this quarter. They have $104 million sitting there on the buyback authorization.
That they can't fully deploy right now because of?
Because of French law. And management just announced a complex, multi-year plan specifically designed to remove that exact barrier. That tells you everything about their priorities.
The timing points to late 2026 for that Luxembourg redomiciliation, the first step that should ease the buyback constraints.
Right. So the outrageous but plausible trade is betting that as soon as that hurdle is cleared, management goes big.
How big?
Well, think about the FCF they'll accumulate between now and late 2026, plus the existing authorization, plus the new flexibility. What if they launch, say, a $200 million accelerated buyback or tender offer almost immediately?
Using that built-up cash and the newfound freedom to just hammer the share count.
Precisely. The Q4 softness everyone's focused on now, that's just temporary cover. It masks the underlying operational strength, the margin story, the index inclusion potential.
And the trade is that this big, unlocked buyback program acts as a structural catalyst, essentially engineering a floor under the share price heading into 2027.
It becomes a powerful leveraged capital return story. That's the aggressive play here. Again, not financial advice.
Definitely not. Okay, so to wrap things up, Criteo delivered a clean beat on EPS and EBITDA, raised the full-year margin outlook, and showed the commerce media pivot is really gaining traction.
Yeah, key takeaways are that margin expansion is real and sustainable, driven by efficiency. And the redomiciliation is a major long-term catalyst for unlocking shareholder value through capital returns.
And maybe the key takeaway for you listening is seeing this transition happen in real time, from ad tech to a high-margin commerce media platform.
That's also positioning itself as core infrastructure for the next wave of AI-driven shopping.
So the final provocative thought then. Considering that AI investment, the Commerce Go traction, that massive new Google partnership tapping into $172 billion, what's the real valuation ceiling for a company like this? A global platform sitting right at the intersection of retail media and AI search.
Something to definitely chew on. And on that note, just a reminder, everything we discussed today is purely for informational purposes. Please do your own research.
Absolutely. Thanks for tuning in to this deep dive.